All right, so hi and welcome to our presentation about Salesforce and Oracle. Let's have a quick look at the table of the content. First, we will talk about the two companies and their financial performance, followed by the financial and M-score and C-score indicators. Afterwards, we will talk about the non-GAAP metrics and group structure, and last but not least, about the major risk factors to accounting integrity. Let's start with an overview of Salesforce. So Salesforce was founded in 1999 by Mark Benioff, a former Oracle manager, and his co-founder, Parker Harris, and is headquartered in San Francisco in the United States. The company is a global leader in cloud-based customer relationship management software solutions. The products help customers to manage sales, services, marketing, and other data in just one platform. Salesforce offers many products and other services, but because of the time, I will just highlight a few of them. So in October 2024, Salesforce released its product called Agentforce. Agentforce enables companies to configure its own AI agent, which can handle customer inquiries, summarize data, and automate other tasks. The service, there are all the cloud applications, for example, the Service Cloud, which centralizes all customer interactions into one system for a faster and more consistent service. The company is still managed by its by the two founders, and Miguel Milano, who is the Chief Revenue Officer, and Brian Wilhelm. Salesforce has a market capitalization of more than 227 billion US dollar, generates an operating cash flow of 13 billion US dollar, employs more than 76,000 people, and has more than 150,000 customers. Just to name the most famous one, it's PayPal, Mercedes, the Royal Bank of Canada, especially in the wealth management division, and the Jubilee store Breitling. Yeah, so let's continue with the financial snapshot. The stock performance is very volatile and influenced by external factors such as the interest rate policy or the tariffs from President Trump. Due to the release of the Agentforce product, Salesforce will change its revenue model. In the future, customers have to pay for each interaction with the AI agent instead of the software as a service model. This makes absolutely sense because Salesforce helps companies by being more productive, and this means that companies has less employees. So the software as a service model doesn't make sense anymore. Since years, Salesforce generates continuously growing revenues, operating incomes, and then continuously growing operating income margin. Nowadays, Salesforce generates revenues of more than 37 billion US dollar, more than 12 billion US dollar in operating incomes, and operating margin of 33%. Most of its revenues Salesforce generates in America, especially in North America, followed by Europe, and through the subscription model. Yeah, so let's have a look at the Oracle overview. Oracle was founded in 1977 by Larry Ellison, who is still in the company and is headquartered in Houston, Texas. The company is one of the leading global provider of enterprise software and hardware, as well as cloud infrastructure solutions. The company's key offerings include the database and management software that helps companies to store, organize, and analyze large amount of data. The Oracle Cloud Infrastructure provides computing power, data storage, and networking through the cloud. The Oracle Fusion Cloud application is an integrated suite of cloud-based business software that helps companies manage their core operations on a single unified platform. There are also Oracle also produce and develop hardware products such as high-performance servers and other storage systems, and offers professional consulting, implementation, and other customer services. Exactly. So Over the last years, Oracle acquired more than 150 companies. Through this strategy, it can expand its capabilities and strengthen its market position across key industries. Oracle has a market capitalization of more than 800 billion, employees more than 162,000 people, and serves more than 145 countries. The company is still managed by the founder, Larry Ellison, who is now the Chief Technical Officer, CTO, Zafar Katz, Mikkel Skiller, and Clay Mogurk. So yes, the key customer are Deutsche Bahn, Dropbox, FedEx, and Spotify. So let's continue with the financial snapshot. In September 2025, the Oracle stock price shows a strong jump. This increase is mainly because of the financial reporting. The cloud infrastructure business grew by 55%, and the remaining performance obligation rose sharply to about 450 billion, driven by a large deal with OpenAI. Some analysts question whether OpenAI can really spend this money because they need to fundraise it to do so. In addition to this, OpenAI raised its revenue forecast for the next years. Oracle generates, as well as Salesforce, continuously growing financials. Nowadays, the company generates more than $47 billion in revenue, more than 17 in operating income, and has an operating margin of 31%. The company generates most of its revenues in America, especially North America, followed by Europe, and through its cloud business.
So here we have an overview of Salesforce financial statements. It should be noted that Salesforce fiscal year begins on February 1 and ends on January 31 of the following year. And what is striking about the balance sheet is that Salesforce has repurchased large blocks of shares. In addition, goodwill is very high, which is not fraudulent in this case, but can be explained by numerous acquisitions. So this is Salesforce's most recent income statement. Here you can clearly see that the net income has increased by 50% within a year, which can be explained by improved operating performance and cost reductions. And furthermore, there are no conspicuous deferred tax tricks or sudden tax burdens. Here in Salesforce cash flow statement, you can see that the repurchase of shares is evident again. What is striking here is that operating cash flow is very strong, whereas net income is rising rather slowly. However, there's a reason for this, as it can be explained by higher stock-based compensation. So let's move on to Oracle and its financial statements. It should be noted that here the fiscal year begins on June 1 and ends on May 31 of the following year. And here also goodwill is very high due to numerous acquisitions, which naturally increase this risk of fraud. However, we do not assume that this is the case here. Here we have Oracle's income statement. What can we say here? Well, revenue has grown by 8%. R&D costs have also risen, but are below what Oracle had actually planned in this period. What is striking here is the jump in tax expenses to almost $12 billion. Okay, let's take a look at Oracle's cash flow statement. It is striking that the financing cash flow is now positive, which can be explained by fresh debt. And in addition, net income and operating cash flow are in line with each other, which is also noteworthy.
So let's have a look at the selected M-score indicators for Oracle and Salesforce. We selected the indicators based on their assumed relevance for both companies. Looking at the days sales and receivables index, which measures how quickly a firm's receivables are rising relative to sales, we can see that for Oracle over the past few years, the indicator has been relatively stable with no major volatility. In the last 4 years, the days sales and receivables index was approximately 1, indicating that receivables and sales grew in line, which raises no concerns or red flags. And for Salesforce, the indicator also shows little volatility. In the last 3 years, the days sales and receivables index was always below 1, meaning that receivables grew slower than revenue, which may reflect improved collections or more conservative revenue recognition. Comparing both, we can see that Salesforce shows a slight positive tilt in receivables management, while Oracle remains steady. Next, we take a look at the asset quality index, which measures the proportion of a company's total assets that consist of less reliable or more judgment-based items, such as intangible assets, capitalized expenses, or other non-productive long-term assets. Oracle's asset quality index has been less than 1, as property, plant, and equipment surged due to large capex, for example, for data centers, which affects both the numerator and the denominator of the asset quality index formula. For Salesforce, the asset quality index was approximately 1, suggesting a modest increase in lower quality assets. Its large goodwill and intangibles stem from recent acquisitions, highlighting the chances of future impairment risk. Next, the leverage index assesses the company's leverage relative to its assets. For Oracle, the leverage index has been roughly around 1, as Oracle has a much larger balance sheet with assets of approximately $140 billion and large borrowings of roughly $85 billion. But their leverage index decreased because their assets grew materially over the last years. And for Salesforce, the leverage index is less than 1. The total assets are approximately $100 billion, and the total debt is $14 billion. Salesforce leverage decreased slightly as assets grew faster than the liabilities. To give an even better assessment of the leverage levels, one can use the debt service coverage ratio or the interest coverage ratio. And both ratios show that Oracle and Salesforce are comfortably in a position where they can comfortably cover their debt obligations and interest expenses. Next, the depreciation index measures the rate of depreciation in the previous year compared to the corresponding rate in the current year. Oracle's depreciation index is larger than 1, driven by a large increase in property, plant, and equipment, while depreciation did not rise proportionately. Although a high depreciation index can signal aggressive depreciation policies, here it mainly reflects rapid asset additions. For Salesforce, we have a depreciation index of less than 1, largely driven due to high amortization of acquired intangible assets from recent acquisitions. To get a broader picture, we are also looking at some selected components of the Montiers Z-score. First, we compare the divergence between net income and operating cash flow. When net income rises faster than operating cash flow, or operating cash flow even declines while net income increases, it can suggest weakening earnings quality. Oracle's rising net income without matching cash flow, particularly in 2018 and 2019, may indicate earnings smoothing or accrual manipulation. However, in recent years, cash flow from operations and net income have grown roughly in line again. Salesforce net income fluctuates sharply due to non-cash items like stock-based compensation and amortization, while its operating cash flow tends to grow steadily. In more recent years, however, cash flow and earnings have moved in line, supporting stronger earnings quality. The depreciation to gross fixed assets ratio measures how aggressively a company depreciates its assets. A decline in this ratio means that the company is recording less depreciation expense relative to its total asset base. Oracle's ratio has declined modestly, as depreciation expense has not fully kept pace with its rapidly expanding asset base from data center capex. Salesforce fixed assets base is also driven by large CapEx and acquisitions that increase its gross fixed assets, but depreciation tends to remain modest, and thus the depreciation to gross assets ratio declines. Rapid growth in total assets, especially above 10% annually, can indicate aggressive expansion or changes in accounting treatments. Oracle's growth via acquisitions contributes heavily to total assets and may suggest overinvestment or reliance on acquisitions to boost the balance sheet. Salesforce rapid expansion and rising intangibles drive asset growth above 10%, primarily by acquisitions and the resulting recognition of goodwill.
So let's take a closer look at how Oracle and Salesforce use non-GAAP metrics in their reportings. Non-GAAP figures adjust official GAAP numbers by excluding certain costs or on one-time effects, often to make company earnings look more favorable. Let's start with Oracle. Oracle is very transparent in its 10K. It provides detailed reconciliations that show how non-GAAP metrics are derived. For example, Oracle adjusts earnings by excluding amortization of intangible assets, stock-based compensation, and acquisitions or restructuring costs. This makes its reporting profitability look higher than under GAAP. And in addition, Oracle also presents segment margins that exclude overhead and other costs. These margins highlight the performance of different business lines, but are not directly comparable to GAAP. It's also important to note that Oracle changed the useful life of its service, which reduced expenses and lifted earnings per share by about 20 cents. This shows how accounting choices can already influence the baseline before non-GAAP adjustments are applied. Now let's look at Salesforce. Salesforce takes a more conservative approach in the 10K. Unlike Oracle, Salesforce does not provide highlighted non-GAAP figures in the official 10K. However, Salesforce mentions that, for example, by restructuring, there are payments that would change the real profit by the company, but in the SEC filing itself, only the GAAP numbers appear. This difference means that while Oracle pushes non-GAAP as a central part of its narrative, Salesforce sticks to the official accounting results in its annual report. So what can we learn from this comparison? First, Oracle is much more proactive in using non-GAAP measures, and it makes them part of its official reporting. Second, Salesforce is more GAAP focused in its 10K, leaving non-GAAP figures for other contexts. And third, while non-GAAP metrics may look attractive, we must remember that they exclude real costs like stock-based compensation, which still affect the shareholders. So to conclude, Oracle and Salesforce adopt very different reporting styles. Oracle emphasizes non-GAAP metrics directly in the 10K, while Salesforce relies mainly on GAAP. For analysts, the key is to consider both perspectives, GAAP for the official baseline and non-GAAP for management narrative. Only combining both, we can form a balanced view of financial quality.
Let's move on to the Salesforce group structure, which we have visualized here. At the top, we see Salesforce as the parent company. Below that are the subsidiaries, which can be divided into completed acquisitions and regional companies on the other hand. And the regional entities are mostly sales companies in the respective countries or exist for legal or tax reasons. As can also be clearly seen here, Salesforce Ventures, which is responsible for startup investments, is listed also on the group, but more on that in a moment. So here we have visualized the group structure of Oracle. Here also there is a parent company, Oracle Corporation, under which all subsidiaries are registered. And the subsidiaries can also be divided into categories here. These are companies for business units, regional companies, acquisitions, one more time, and administrative subsidiaries. Oracle has Oracle relies also heavily on acquisitions, which are the number one driver of the size of its subsidiary network. And it could also be noted here that Oracle has much larger corporate network than Salesforce, with just under 750 companies. This is probably also the reason why they do not place much emphasis on joint ventures. So let's move on to consolidation methods. So what are they? There's the full consolidation method, the equity method, and the fair value method. Both companies use the full consolidation method. This means that it applies to all companies over which they have full control and in which they hold more than 50% of the voting rights. All key figures after elimination of intercompany transactions are included in the consolidated profit and loss statement. Only Oracle uses the equity method. This refers to non-controlling companies. So this means that Oracle discloses the share to which is entitled. Salesforce does not use this method as it generally avoids entering into minority investments. But both companies use the fair value method. So Salesforce use it for Salesforce Ventures and Oracle for investments without significant influence. Here, the investment is recognized at fair value in the balance sheet of the company. Okay, so where could potential fraud occur? First, there is risk in the fair value assessment of strategic investment of Salesforce. So they use estimates to value unlisted holdings, which can lead to inflated valuations or delay write-downs. Second, goodwill and intangible assets pose a risk with quite over $50 billion in goodwill from acquisitions relying on internal forecasts with impairments could potentially constitute fraud. And third, the complexity of global consolidation brings its own risks. Errors in eliminating intercompany transactions may result in unusual balances or sudden pricing inconsistencies. Coming to Oracle first, the full consolidation carries manipulation risks. So failing to properly eliminate intercompany transactions can artificially boost reported revenue and profits. Second, Oracle's complex chain structures reduce transparency. So using entities in low tax jurisdictions enables profit shifting from high to low tax countries and may lead to round tripping, inflating revenue, or capital flows. And last but not least, third, the equity method introduces discretion. So Oracle may understate its influence over investments to delay recognizing losses with recording gains immediately.
Now let's take a look at major risk factors both companies have when it comes to accounting integrity and potential conflicts of interest or incentives to overreport earning. Let's start with the revenue recognition. Salesforce earns money from many different sources like subscription, support, and consulting. That makes revenue recognition pretty complex. Managers have to decide when revenue is recognized and how contracts are split into performance obligations. This flexibility gives them the chance or the temptation to book revenue a bit earlier to hit growth targets at the end of a quarter. Let's continue with stock-based compensation. A big part of Salesforce cost comes from stock-based pay for employees. When a company shows adjusted results that exclude costs, profits can look higher than they actually are. Since management bonuses depend on share price and growth, there is an incentive to show stronger adjusted earnings than the GAAP numbers would suggest. Acquisitions and goodwill. Salesforce has bought a lot of companies like Slack, Tableau, and MuleSoft. That means there's a lot of goodwill on the balance sheet. Every year, management has to decide if that goodwill lost value. Because this depends on their own assumptions, there's the risk that they will delay write-downs to keep profits steady. So the cost capitalization. Some costs like software development or contract-related expenses can be capitalized instead of booked right away. That's allowed, but it gives flexibility to push costs into the future, which can make short-term margins look better than they really are. Executive incentives. Management bonuses are tied to revenue growth and profit margins. That means there is pressure to meet targets, which can lead to optimistic accounting decisions, for example, delaying expenses or emphasizing adjusted figures. Transparency and disclosure. Because Salesforce keeps acquiring new companies, its reporting structure is complex. Analysts have to rely on internal data, which makes it harder to verify each part of the business is performing. That increases the risk of less transparent reporting overall.
Analyzing the major risk factors to accounting integrity and potential conflicts of interest to over-report earnings, our analysis of Oracle indicates that expansion through acquisitions has built up significant goodwill and intangible assets. These require annual impairment tests that rely on subjective judgments regarding cash flow, discount rates, and growth projection. Similar to other tech companies, Oracle highlights non-GAAP indicators that exclude recurring costs like stock-based compensation, amortization, and restructuring charges. This can make earnings appear more stable or stronger compared to official GAAP figures. Executive compensation is strongly tied to earnings per share and stock performance, since non-GAAP results usually omit stock-based compensation. This setup can incentivize the overstatement of profitability or the deferral of costs in order to meet EPS goals. Oracle also discloses only limited information on its segments and on cloud versus license revenues. This restricts analysts' ability to independently validate performance and increase reliance on management's reporting.
Now let's compare Oracle and Salesforce based on their accounting quality. Starting with the balance sheet. Salesforce has a strong equity base of around $61 billion and only $8.5 billion in debt, showing a conservative and low-risk capital structure. It also holds about $55 billion in goodwill and intangibles, which is high but still supported by solid equity. Oracle, on the other hand, carries heavy debt of $85 billion and only $21 billion of equity, making it much more leveraged. It also has around $62 billion in goodwill and intangibles, which, combined with the high debt, creates a more risky balance sheet. Looking at the income statement, Salesforce reported $37.9 billion in revenue, mostly from subscriptions, and a net income of $6.2 billion, giving a margin of about 16%. Oracle generated $57 billion in revenue and a higher margin of 21%, but it's reporting in less transparent because cloud and license income are grouped together. Now for cash flow. Salesforce shows a strong operating cash flow of $13 billion, mainly driven by deferred revenues from its subscription model. This makes its cash generation sustainable and recurring. Oracle's cash flow is also stable, but it's partially financed through a $14 billion bond issuance, showing a higher reliance on external funding. In terms of reporting structure, Salesforce operates with a simple single segment model, which is easy to understand. Oracle reporting is more complex with many subsidiaries and large commitments, making it less transparent. So to conclude, Salesforce accounting is transparent, conservative, and sustainable. Although it still faces risk from high goodwill and capitalized costs, Oracle, in contrast, is more aggressive and performance-driven, showing higher profitability, but at the cost of higher risk and lower clarity. Thank you for your attention. If there's any questions occurring, please feel free to approach us in the next lecture. And here are our sources. Thank you very much.